Accounting Standard 6 Depreciation Accounting. So in this section we will talk about depreciation accounting. We'll touch base with what is accounting standard. We'll see what are the different types of the depreciation methods, which may be straight line method, written down value method, or sinking fund method. We'll see an illustration of or an example, and we will go through what each of these methods mean. So first is depreciation accounting. Depreciation is the fall in the value of an asset, mostly fixed assets. It is also the reduction in usable value of fixed assets due to efflux of time, obsolescence, the state of being obsolete, and due to wear and tear. Correct profits emerging out of fixed assets cannot be calculated unless proper charge of depreciation be made. So what is depreciation? It is a gradual reduction in the value of an asset over time. And it may be due to wear and tear. It may be because of the fact that the product is getting obsolete. Now, correct profits emerging out of fixed assets cannot be calculated unless we make provisions for depreciation also. Now, let us see what is the accounting standard on depreciation, about accounting standard 6. So this is a mandatory accounting standard. It explicitly states that the disclosure requirements connected or in relation to accounting for depreciation. For fixed assets, it suggests various methods of depreciation, and we will examine each one of them in this section. It mentions the factors that affect depreciation and the treatment extended should the method of depreciation changes. It does not apply to plantations, forests, wasting assets, livestock, goodwill, and land. So for all of this standard does not apply, which are plantations, forests, wasting assets, livestock, goodwill, and land. For this standard does not apply. So hence disclosures are required for depreciation methods used, gross amount of depreciation in each class with accounting policies, as well as for total depreciation. So for each depreciation method which is used to find out how much is the depreciation on a fixed asset, that disclosure we actually need, which is a mandatory requirement. We also need gross amount of depreciation in each class. That also we actually require, along with the accounting policies used for calculating depreciation. Also, we have to disclose what is the total depreciation. Now let us see what are the different depreciation methods. Basically, there are three methods of depreciation followed, namely straight line method, written down value method, and sinking fund method. So we'll see what each of them means. In straight line method, depreciation is calculated in such a manner that there is a suitable fixed percentage of assets' original cost written off every year, and the amount written off is given by some equation which is actually given here. Cost price of an asset less scrap value of an asset over estimated life of an asset in number of years. Now let us see what is cost price of an asset, which is the price at which we acquired the asset. What is the scrap value of an asset? Scrap value of an asset is after some time an asset becomes unusable. So that state of unusable asset is actually the scrap value of an asset. Now what is the difference between these two is divided by estimated life of an asset in number of years to arrive at a depreciation figure, and that is actually by straight line method. Now the scrap value of an asset is the value of an asset when it remains no more usable for the purpose for which it was originally intended. So that is explained. So the difference between cost price of an asset and scrap value is divided by the estimated life of an asset in number of years, gets you the depreciation rate per year. Next it is what is written down value method. In written down value method, the percentage rate of depreciation is fixed, but it applies to the value at which asset stands in the book at the beginning of each year. It is calculated in a similar manner. The depreciation rate is given at first for written down value method, And then we take the difference of cost of asset and salvage value of an asset, which is again the value of an asset where the asset is no more usable. It's only not usable at all. So that difference is again multiplied by rate of depreciation to arrive at the depreciation. The only difference is that in the case of written down value method, the percentage rate of depreciation is fixed, but it applies to the value at which asset stands in the books of at the beginning of each year. So when we open the book at the beginning of each year, whatever is the value which we see, based on that value only, we take the cost price of an asset or the actual value of an asset. And the difference of salvage value is taken from the value at which at the beginning of each year, whatever is the book value, we actually consider. So that is the main difference. We will explain it when we actually see the example. And lastly, it's sinking fund method. So in sinking fund method, what happens is when one writes off depreciation, sufficient provisions are made by him for making that provisions for funds to enable business to replace the asset. So in sinking fund method, there is sufficient provision made for funds to enable business to replace the asset. Hence, the amount written off as depreciation is normally invested in readily saleable securities, so that all assets and the securities so acquired are sold to replace the asset. So there's a fund also which we actually accumulate over time. So whatever is the amount of depreciation written off, we actually invest it in that fund. And gradually after the end of that useful life period of our asset, we will be in a position to buy a new asset using the sinking fund. So in this exercise, we illustrate how the different methods of depreciation are calculated. We will now go to the problem or the Excel spreadsheet problem where we actually see what are the different methods which we actually have explained, and we will go through with the example in the Excel spreadsheet. So the illustration is, the example is, transport company XYZ acquired a truck on 1st October 2007 at a cost of rupees 4 lakh, that is 400,000. The firm has depreciation set at 10% of the original cost each year. On 31st March, the books are closed. Show the truck account and depreciation account for 3 years. So the truck actually is acquired by company XYZ at rupees 4 lakh or 400,000. So the first entry in the book of the company XYZ is that there is a truck which is acquired at 400,000 rupees. So we say to bank account 400,000 rupees. Now the depreciation amount is set at 10% of original cost of each year. So 10th of October, and the financial year ends on March. That is, the books are closed on 31st March. So that would mean that the depreciation is 10%. 10% of 400,000 is 40,000. About half of which we charge as depreciation because we only have got 6 months as a time period. So on 31st March, when the books are closed, we say the depreciation is 20,000, which is half of 10% for 1 year, or 5% is what the depreciation we charge, which is actually 10%. We charge it only for 6 months. Now the difference is what we actually brought down. It's carried down is 3,80,000, and we brought that down to 3,80,000. And again we calculate depreciation, but this time the depreciation is 40,000. So this year the depreciation is 40,000. The difference would be 3,40,000, which is carried down, and we will we'll bring that down as 3,40,000. Again, for the year after next, the depreciation charge is 40,000. Ultimately, whatever balance we carry down is 300,000. So if you calculate the depreciation in that way, the depreciation, that is straight line method, we arrive at the figure 300,000 at the end of 3 years. So the total depreciation may be 40,000, 40,000 and 20,000, which is 1 lakh. So that is by straight line method. Now the next, and in the depreciation account, this is how we actually write. We say to truck account 20,000 for the first year, and by profit and loss account we actually have 20,000 on the credit side, and on the debit side we have 40,000 for truck account, and by on the credit side it is 40,000. So this is how we write the books, but ultimately the total depreciation charge would be 1 lakh. So we have 300,000 as the balance which is carried down. That is by straight line method. Now let us see what figures we get by written down value method. The depreciation calculation is the same. The only difference is in the amount that is carried down. So on 31st March 2008, when the books are closed, the balance which is carried down is 3,80,000, which would be brought down in the new year, which is 1st April 2008. So the depreciation calculation on in the year 2008, we do it based on this 3,80,000 and not 40,000. That is why 10% of 3,80,000 is what we charge for depreciation, which is 38,000. Similarly, for year 2009, the depreciation calculation is calculated based on whatever is the balance brought down, which is 3,42,000. And then the depreciation calculated is 34,200. So actually the depreciation calculated by written down value method may be a little bit lower. So the total amount, the asset value is 3,07,800. The depreciation would be the cumulative amount of 34,200, 38,000 and 20,000. So there is so the depreciation is lower in the case of written down value method. It may be a little bit higher in the when we do the straight line method. So that is the difference. Now, in written down value method, to understand that we are given the depreciation rate, we simply multiply the depreciation rate with the difference in the cost of machinery and scrap value. So that is what is illustrated, and we have explained sinking fund method. Thank you.